Imagine two investors. The first investor wakes up every morning checking social media, reading headlines, and searching for the next big opportunity. Every week, there's a new trend, a new promise, and a new prediction about where the money should go. The second investor does something very different. Instead of asking, "What's popular right now?" they ask, "What creates real value? What solves a real problem? And what assets support that value?" Over time, these two investors often end up on very different paths. One follows speculation, the other focuses on asset-backed investing. Today, we're going to explore the difference between the two, why experienced investors rarely chase hype, and why many of the world's most successful investors build their portfolios around businesses and assets that are connected to real economic activity. This is not about chasing shortcuts. It's about understanding how long-term wealth is often built through patience, knowledge, and a clear understanding of how value is created. Speculation isn't necessarily a bad word. In fact, speculation exists in almost every financial market. At its core, speculation means buying something primarily because you believe someone else will pay more for it in the future. The focus is often on price movement rather than underlying value. Speculative markets are usually driven by emotion, such as excitement, fear of missing out or FOMO, rumors, headlines, and viral content. And when emotions drive decisions, people often stop asking the important question: how does this business actually make money? What real problem does it solve? What demand supports its value? And who are the people operating it? Speculation can produce rapid gains, but it can also create rapid losses. History is full of examples where investors rushed into trends without understanding the fundamentals, only to discover later that popularity alone is not a business model. Experienced investors understand that excitement can create momentum, but momentum is not the same as value. One of the easiest ways to recognize speculation is by listening to the conversations people have around an opportunity. Very often, the discussion is not about the business itself. People aren't asking how the company operates or how revenue is generated. Instead, the conversation becomes, how high can the price go? How quickly can I double my money? What if I miss out? When questions shift away from value and toward excitement, speculation often takes over. Experienced investors understand that excitement can create temporary momentum, but long-term value is usually built on something more sustainable than public attention. That is why many seasoned investors spend more time studying industries than studying trends. Why do so many people get caught up in speculation? Because human psychology plays a powerful role in investing. When we see others succeeding, we naturally want to participate. When social media is filled with stories of overnight success, it's easy to believe opportunities only exist for those who quickly move. Easy to believe opportunities only exist for those who move quickly. But successful investing is rarely about speed. It's about discipline. Professional investors understand that the market rewards patience more than impulse. They know that the fear of missing out can be more dangerous than missing an opportunity. In fact, many investors have a simple philosophy. If you don't understand how it works, you probably shouldn't invest in it. That doesn't mean avoiding innovation or new industries. It means taking the time to understand the business before committing capital. Social media has changed the way people discover investment opportunities. Years ago, investors often learned about businesses through research, professional networks, or direct industry experience. Today, a single viral post can bring millions of views to an investment idea overnight, but visibility and credibility are not the same thing. An opportunity can be popular without being fully understood, which is why experienced investors develop the habit of slowing down. Instead of reacting immediately, they investigate. They ask questions. They read and they compare. Especially, they follow the facts, not emotions, to guide their decisions. Asset-backed investing starts from a different question. Instead of asking, will this become more valuable tomorrow? It asks, what real asset or business activity is creating value today? An asset-backed investment is connected to something tangible or economically productive. That could include infrastructure, equipment, real estate, industrial assets, or businesses that provide essential services. The underlying principle is simple. The asset exists because it serves a purpose. It solves a problem, it helps businesses operate, and because it has practical use, it has the potential to generate economic activity. This doesn't mean asset-backed investments are risk-free. No investment is. But many experienced investors appreciate opportunities where they can understand the asset, the business model, and the source of revenue. They are not relying solely on future expectations. They are evaluating something that already has a role in the economy. One reason why many investors appreciate asset-backed opportunities is because they can often visualize what they are investing in. A physical asset has a purpose. It exists because businesses or customers need it. The practical use creates the possibility for economic activity and revenue generation. Think about the infrastructure around us every day. Warehouses, transportation equipment, industrial machinery, and logistic facilities. These assets all exist because they solve real operational problems. Asset-backed investing often begins by asking a simple question. If this asset disappeared tomorrow, would businesses still need what it provides? If the answer is yes, then the asset may have long-term relevance beyond short-term market trends. Take a moment and think about the products you use every day. Your phone, your laptop, the furniture in your home, the materials used to build roads and buildings. Most of these items have traveled through complex supply chains before reaching their destination. Behind those supply chains is a network of infrastructure that keeps the global economy moving. One of the most recognizable parts of that system is the shipping container. At first glance, a shipping container may seem ordinary, but in reality, it is a critical component of global trade and logistics. Containers are used to transport goods, support storage, operations, and help businesses move products efficiently around the world. They are practical assets connected to everyday economic activity. Their purpose is clear. Their demand comes from businesses that need reliable logistics and storage solutions. This is why many investors pay attention to industries that support essential infrastructure, not because they are flashy, but because they perform a necessary function. Global trade has evolved dramatically over the past several decades. Products are no longer manufactured and consumed in the same place. Raw materials, components, and finished goods often travel across multiple regions before reaching the customer. This complex movement of goods depends on reliable logistics infrastructure. Shipping containers help make that system possible. They create a standardized way to transport and store products safely and efficiently. Many experienced investors find this interesting because the value proposition is relatively straightforward. The asset is tangible, its purpose is easy to understand, and the demand is connected to real business activity rather than short-term market excitement. The goal isn't to predict what people will be talking about next month, but the goal is to understand whether the asset serves an ongoing need. Many people are surprised to learn that shipping container industry extends far beyond cargo ships. Today, containers are used by retailers for additional storage, by construction companies for equipment security, by manufacturers for inventory management, and by logistics providers for operational flexibility. The demand for container solutions comes from businesses trying to improve efficiency while managing costs. For many companies, leasing is an attractive option because it provides access to equipment without requiring a large capital purchase. This allows businesses to remain flexible while adapting to changing operational needs. For investors studying the industry, understanding these practical applications provides important context. The focus is not simply on the container itself, but on the role it plays in supporting commercial activity across multiple sectors. One of the biggest differences between new investors and experienced investors is where they spend their time. New investors often spend more time looking for opportunities, while experienced investors, they spend more time understanding opportunities. They ask questions. They study industries. They learn how business operates. And they evaluate management, operations, demand, and long-term stability. And perhaps most importantly, they understand that protecting capital is just as important as growing capital. This is where due diligence becomes essential. Before making decisions, experienced investors seek clarity. They want to know the following questions, like where does the revenue come from? What supports the business model? What factors could affect performance? And what are the risks? Because informed decisions are usually better than emotional ones. There is a saying often repeated in the investment world: never invest in something you cannot explain simply. Experienced investors strive to understand opportunities well enough that they could describe the business model to someone with no financial background. If the explanation becomes overly complicated or relies entirely on assumptions about future prices, they know it may deserve additional research. Clarity creates confidence. And confidence comes from understanding, not from excitement. So what is the real difference between speculation and asset-backed investing? Speculation can be driven by headlines, while asset-backed investing is driven by understanding. Speculation often depends on market sentiment, while asset-backed investing begins with assets, businesses, and real economic activity. That doesn't mean one approach guarantees success and the other guarantees failure. Every investment carries risk because markets change, industries evolve, and conditions fluctuate. But experienced investors understand that knowledge is one of the best forms of risk management. They don't simply follow attention. They seek understanding. They don't invest because everyone else is talking about something, but they invest because they have taken the time to learn how it works. Speculation often focuses on what might happen tomorrow, while asset-backed investing starts by understanding what is already happening today. Questions such as what business need is being solved, what service is being provided, and what demand supports the asset. These questions encourage a more thoughtful approach to investing, because while markets will always change and trends will always come and go, the ability to analyze opportunities with patience and discipline is a skill that remains valuable in any environment. And that may be the greatest advantage experienced investors have. Not that they always know what will happen next, but that they understand the importance of looking beyond the hype and focusing on the fundamentals. And perhaps that's the biggest lesson of all. The most successful investors are not always the fastest, but they are often the ones who remain patient, ask better questions, and focus on opportunities connected to real value. Because in the long run, trends may come and go, headlines will change, markets will move, but businesses and assets that continue to solve real-world problems will always have a place in the economy. So thank you for watching, and if you enjoyed this discussion and would like to explore more topics about investing, real assets, and long-term wealth building, don't forget to like, subscribe, and join us for the next episode. See you again. Thank you.